Right now, as we watch the ticker tape flash across the screen, Super Microcomputer Inc., trading under the symbol SMCI, is changing hands at exactly $35.15. The market is open, the liquidity is flowing, and we are seeing a push to the upside today, with the stock currently registering a gain of approximately 1.32%, or roughly $0.46 from the previous close. The intraday range has been tight but active, oscillating between a low of $34.76 and a high of $35.39, with volume already surging past 3.1 million shares in the early hours of this session. This isn't just a number on a screen, it is the pulse of a company that has become one of the most polarizing battlegrounds in the entire technology sector. If you are looking at your Robinhood app right now, you might see the green arrow and think the coast is clear, but the price action tells a far more complex story of hesitation, algorithmic fighting, and a retail base that is desperate for a return to the glory days of triple-digit valuations. The expectation right now, the narrative that is being sold on message boards and investing sites, is that Super Microcomputer is a coiled spring, a deeply undervalued artificial intelligence infrastructure play that has been unfairly punished by temporary accounting concerns. Investors look at the price-to-earnings ratio, they look at the explosive demand for NVIDIA's Blackwell chips, and they convince themselves that this is the bargain of the decade. They believe that once the dust settles, this stock will inevitably march back towards its all-time highs, fueled by the insatiable global appetite for compute power. That is the expectation. The reality, however, is far more jagged and uncomfortable. The reality is that SMCI is no longer just a hardware story. It is a governance show-me story, where every single tick of the stock price is a referendum on trust. The market isn't pricing in growth right now, it is pricing in survival and verification. While the company has managed to navigate the treacherous waters of auditor resignations and NASDAQ compliance deadlines that terrified the street late last year, the stock remains trapped in a purgatory of skepticism. The recovery to $35.15 isn't a victory lap. It is a stabilization level where the bulls are trying to build a floor, while the bears are betting that margin compression will do what the auditors couldn't: crush the valuation. When we analyze the microstructure of today's trading, we see a distinct battle between high-frequency algorithms and frustrated retail capital. Unlike the smooth, almost inevitable ascent we often see with Apple stock or the robust volume-backed moves in NVIDIA stock, SMCI's movement today feels jittery. It snaps up 20 cents, then grinds down 10 cents. This specific type of price action usually suggests that Interactive Brokers' stock trading desks are keeping tight leash on leverage. The margin requirements for SMCI have likely remained elevated at many clearinghouses, which naturally dampens the ability for traders to pile in with the same reckless abandon they used during the meme stock frenzies of the past. You can see the hesitation in the order book. There are thick walls of sell orders sitting just above the $35.50 mark, acting as a resistance that the bulls have to chew through. This resistance isn't just technical, it's psychological. It represents the break-even point for thousands of traders who bought the dip months ago and are just looking to get out with their shirts intact. Let's talk about that dip, because to understand why $35.15 matters, we have to respect the violence of the drop that brought us here. This isn't a standard correction. This was a complete repricing of risk. When the previous auditor, EY, resigned, it sent a shockwave through the financial system that made even the most hardened volatility traders flinch. It wasn't just about numbers. It was about the integrity of the information. For a Fidelity brokerage account holder who prizes safety and due diligence, that resignation was an immediate sell signal. We saw institutional capital flee in a way that rarely happens to companies of this size. The stock didn't just fall, it evaporated. And yet here we are, stabilized in the mid-30s. Why? Because the company brought in BDO, they filed their compliance plans, and they proved that the business itself, the actual selling of servers, was still operational. But the scar tissue remains. The current price reflects a market that is saying, we believe you exist, but we don't trust you yet. It is fascinating to compare this sentiment to Tesla stock. Tesla has historically thrived on chaos. Its investors wear volatility like a badge of honor. SMCI investors, however, are different. They didn't sign up for a governance crisis. They signed up for an AI pick-and-shovel play. They wanted the boring, profitable business of selling racks to data centers. Instead, they got a drama that rivals a courtroom thriller. This misalignment between what investors wanted and what they got is what creates the current tension in the price. You have people holding this in their Fidelity IRAs who are terrified to sell at a loss, but terrified to hold. Then you have the aggressive traders on SoFi active investing platforms who are scalping the volatility, buying at $34 and selling at $34.80, caring nothing for the long-term fundamentals. This clash of time horizons is what creates the chop we are seeing on the chart today. Now, I want to pause for a second and ask you a direct question about your own positioning in this chaos. Comment below how many shares of super microcomputer you currently hold, and be honest, what is your average cost basis? Are you one of the lucky ones who got in under $30, or are you holding bags from the pre-split era? I want to see the distribution of holders in the comments because it gives us a better sense of the potential selling pressure that might still be lurking overhead. Moving deeper into the mechanics of the trade, we have to look at the broader sector context. You cannot trade SMCI in a vacuum. It is inextricably linked to the performance of NVIDIA stock. When NVIDIA sneezes, SMCI catches a cold, or in some cases, pneumonia. Today, with SMCI pushing up 1.32%, we have to check the semiconductor index. If chips are rallying, SMCI is just drafting behind them. But if chips are red and SMCI is green, that shows independent strength, which is a rare and bullish signal. Currently, the correlation remains tight. SMCI is effectively acting as a high beta proxy for the AI hardware trade, but with an added idiosyncratic risk premium. That means if the AI trade goes up 1%, SMCI might go up 2%, or it might go down 5% if a new headline hits. This asymmetry is what makes online investment decisions so difficult for the average person. If you are using Schwab Intelligent Portfolios or a similar SoFi robo-advisor, you won't find SMCI in your automated basket. These algorithms are designed to minimize the exact kind of single-stock governance risk that SMCI represents. This leaves the stock in the hands of active managers and retail pickers, creating a shareholder base that is more emotional and reactive than the shareholder base of a blue-chip utility. Let's address the Fidelity Wealth Management perspective. The big money, the pension funds, the endowments, they need certainty. They can handle a bad quarter of earnings. They cannot handle a bad quarter of accounting. The hiring of BDO as the independent auditor was the first step in stopping the bleeding, but the market is now waiting for the all-clear signal that only comes with consecutive quarters of clean, on-time filings. Until that track record is reestablished, SMCI will likely trade at a discount to its peers. We are seeing this discount in real time. A company with this revenue growth profile should theoretically command a much higher multiple, but the governance discount is acting like a heavy anchor, dragging the price down every time it tries to break out. This is why you see the stock struggle at resistance levels like $38 or $40. It's not that the sellers don't believe in AI, it's that they're using every pop to reduce their risk exposure. However, we must also look at the fundamental business because eventually stock prices do follow earnings. Supermicro isn't selling vaporware, they are selling the physical infrastructure of the 21st century. Their building block architecture is a legitimate competitive advantage. It allows them to customize server racks for clients faster than almost anyone else. When a hyperscaler needs liquid-cooled racks for a massive new cluster, SMCI can often deliver the prototype and the final product weeks or months faster than the competition. This speed is critical in the AI arms race. Tesla stock rose on the promise of speed and innovation. SMCI rose on the promise of deploying that innovation physically. The liquid cooling technology specifically is a massive moat, or at least it was. The reality check here is that